Good morning, my Teaserking family. YouTube's acting up. First, I couldn't get a chat, then I couldn't go live. I got to shut down, come back up. Anyway, I am finally here. And there was a few things that I talked about yesterday that I thought I had captured that didn't. And I got the internet problem and I thought I was still on and I wasn't. So I got I got most of the baseball in. And I don't know how much of the economics. So we're going to go back over the economics. First, we'll take our look at gold. 33.41 at 11 o'clock. And silver's doing well, 36.43. The longer silver goes and stays over 36, the better it is. We're waiting for that. The Basel 3, where now they don't short it as much. Still playing a little bit of the game with the gold, where they're still kind of playing around with it. But now they got to come up with delivery. So yesterday was Basel 3 day. I did explain it, but I don't think it got into it. So I'm going to explain it again. So I asked the question, what is Basel 3 for silver on COMEX? Basel, and it's the same for gold. Basel 3 is an international regulatory framework aimed at strengthening the global banking system. For silver on the COMEX, it primarily impacts how banks hold and trade unallocated silver, which is silver that isn't anybody's, right? So if China wants silver, it's now allocated to China. This is not allocated to anybody, potentially driving up demand for physical silver and influencing prices. Specifically, Basel III requires banks to hold more capital against their assets, including unallocated precious metals, making it more expensive for banks to hold unallocated silver. Point is, more physical, higher price. That's why we're excited. Impact on unallocated silver. Let's get the definition of unallocated silver. On the COMEX, unallocated silver represents a type of silver investment where the investor doesn't own specific identified physical silver coins or bars. Instead, they have a claim on a pool of silver held by a financial institution like a bank. This makes them an unsecured creditor of the bank with a general entitlement to a certain quantity of silver, but not necessarily a specific piece. Here's how unallocated silver works on COMEX. Pooled ownership. The silver is part of a general stock, not held as distinct bars or coins specifically by one investor. So you might have 1,000 bars in COMEX, and it's not allocated to China or Russia or India. It's just there, and you have a claim, and you get one of the bars or 100 bars or whatever you get, but it's not yours. Bank ownership. The silver is legally owned by the bank or institution, not the investor who holds an IOU or claim on the silver. Flexibility and lower cost. Unallocated silver is generally favored for its ease of buying and selling and potential lower storage fee because the bank can handle and trade the metal more efficiently. Counterparty risk. This arrangement carries counterparty risk, meaning the investor depends on the bank's ability to fulfill its obligations, and there's a risk of loss if the bank fails. That's why people are asking for delivery on theirs when they do their options. They want delivery on it because they think there's a lot of counterparty risk. They don't think they'll get it. Basel III impact. Basel III significantly impacts unallocated silver on COMEX by requiring banks to hold more capital against those holdings. So they got to hold more silver and gold, which they don't have. So they'll have to buy more, which they don't have, and it'll raise the price up. Making them less attractive for banks and potentially driving them towards holding more physical allocated silver. So if I got 1,000 bars, but I got 2,000 people wanting them, I can't deliver. I'm in trouble. They want the delivery. So I got to keep more inventory in COMEX. And that's where, I got to go buy it. In essence, unallocated silver on COMEX allows investors to gain exposure to silver's price movements without the direct costs and logistics of storing physical metal, but it comes with the trade-off of not having direct ownership and incurring counterparty risk. Allocated versus unallocated silver. There is something in 2022 on Bullion Max. I don't know what that is, but we can look at the difference. I just believe it's what's owned by COMEX. All right, shift to physical silver. Due to the increased cost of holding unallocated silver, banks may reduce their exposure to it, potentially leading to a greater demand for physical silver bars, which is what everybody's taking delivery on. That's the key. So Basel III forces them to hold more inventory, which they don't have, to pay people who are doing the options to take delivery. So they got to have the gold and silver to take the delivery. So people are going to physical because they know they have it. They don't want to be out of it. Increased capital requirements. Banks will need to hold more capital against their unallocated silver holdings, which could lead them to reduce their positions or increase their capital reserves, which means either they don't do as many shorts because they don't have the inventory, or they get more inventory. So they'll probably reduce their positions because they can't get, gold and silver are gone. Potential price impact. The increased demand for physical silver and the potential reduction in unallocated silver holdings could lead to a rise in the price of physical silver. COMEX delivery. Increased demand for physical delivery on the COMEX could put pressure on the exchange to deliver more physical metal, especially if banks are moving away from unallocated positions. So it puts more pressure on them to deliver the physical metal. In essence, Basel III is reshaping the dynamics of the silver market by favoring physical ownership over the paper derivatives and potentially driving up the price of physical silver, according to some financial analysts or economists like the professor. Will Basel III boost gold and silver prices? Of course it will. This is back in 2021. I'm not going to waste time. Yes, Basel III applies to silver. It applies to gold. So that's why we're all excited, because that's going to force. Yeah. We're going to force them to hold physical. We're going to force the market to physical. And the real price and a physical price, as I said, is up here, and COMEX is down here because they keep flooding the market with paper, gold, and silver. That is not real. That's the same bullshit as this. So they'll come out with the paper. All right. So with that said, there's a few videos we need to see. So basically, we were watching this. Trump just crashed the dollar, and China's global takeover has begun, which we'll get into after we look at. So I wanted to show you the last 5 minutes of Mark McGuire.
Investments in gold, silver, or cryptocurrency with that net of the tiny volume of 9,682 1,500 tons rinsed out, even averaging the spot premium to futures at, say, 6 cents, that's close to $3 million of house positions that have been rinsed out by the pit managers. That's the game. This is telegraphing. Foreign exchange silver is being locked in, though, because the foreign exchange price is higher than the futures price. Because it's being locked in at the FX fixes to future at premiums. And it also indicates the imminently expiring July COMEX silver contract, which goes into delivery at the end of June, will be stood for delivery and will be drained of cheap, immediately accessible silver and the current open interest that remains. So the potential delivery exposure right now is a very large 6,000 tons. And while a lot of these positions will, of course, they'll be rolled into the upcoming September contract, there are only 2 sessions left to actually deliver the last 1.4 tons of June deliveries. Why the heck anyone would hang on to the last day to deliver a June delivery that should have actually been delivered at the end of May? So to sum up, basically, both of these bid pooled efforts in gold and silver are options, OCC related, ahead of options expiry today and OCC related capping. And it's being led by Citi, stick handling official OCC bets. And while we expected a last kick at the can ahead of US Basel III compliance, all it has achieved is to secure the next higher, globally determined, higher price stair step with almost no paper speculators on board to rinse. Just to finish up, though, we have contacts on the ground and we'll be closely monitoring the upcoming 17th BRICS Summit in Rio on the 6th and the 7th of July. And we're going to provide a full update in our last episode that will be recorded on the 9th of July. So BRICS, remember, is a platform for accelerating financial multipolarity with a view to expanding the new development bank so as to bolster national currencies in intra-BRICS trade benchmarked to gold. That's the key thing. And with gold markets now being discovered in Ava and prices now being discovered in Asia, as Bloomberg draws attention to, it provides the BRICS autonomy. Gold is already being price discovered in the Eastern physically backed markets. The formalizing of the financial infrastructure to support liquid global settlement is the final piece of the puzzle, and it will be the death knell of the COMEX if it does not become Basel III compliant. We talked about it before. Yeah, you can avoid being Basel III compliant. You can keep playing your paper game, but you've got less and less people to actually cover your exposure into. So you're in trouble. And simply what happens is you're going to influence the fixed price through your COMEX gaming, and that's going to be delivered. And then they're going to turn around on you. And what they're doing in silver right now is loading up at the back door and taking it and literally draining those vaults. So unless it becomes Basel III compliant, goodbye. Now, gold is strengthening the BRICS currencies at the expense of the dollar. In case you haven't seen the ECB financial stability review, drawing attention to the unallocated paper gold to physical imbalance, identifying large foreign counterparty derivative exposures that must be brought back into essentially rising prices. So the only question left to ask our dear subscribers is, how prepared are you?
So as he said about a minute ago about COMEX, you can ignore the Basel III, but you're still going to get screwed by the physical. So the Basel III is, even if the U.S. ignores it, they're still going to be screwed because the banks are going to want physical, and the countries are going to want physical, and there's just not going to be the buyers who are going to take, who are going to take the paper, take the IOU. Again, that's the unallocated. And again, that's the point of Basel III, why we're all excited, because they have to start carrying more physical. And as he's saying, well, if they don't, they're screwed anyway. They're still screwed if they don't go Basel III, because everybody's going physical. And there's less people going short on it. So to answer Prophet's question, when's it going to happen? When's it going to happen? Well, we already saw it at 34.40, and we're looking for a much higher gold and silver prices. Silver's in the mid 36s, 36.50, I believe, and gold is at 34.40 or 33.40. And just look for it. We've seen it in the 34s, so we know it's getting back there. They can try to keep it low, but there's too much buying going on by BRICS. They need the gold. China's broke, but they have a lot of gold, so China will play that card. Japan, the same thing. They're broke. Most of the countries are broke. They're all going to the same system of paper and fiat money, under the impression that actually that'll work. And we know the fiat system's not possible to work, because you keep expanding the military and you keep expanding the government and you keep printing money. Since the money's not backed, the money's worthless. You can have things not backed by anything, like paper gold and paper silver. It's not backed by anything. So you have to have it backed. This must be backed by gold or silver for it to have value. And the mistake that they keep making over and over and over is, hey, we won't back it by anything, and we'll see how long it lasts. And they keep printing it, and people realize it, and prices go up because they keep printing it. So you go to the grocery store, everything's more expensive because they keep printing it. And that's a problem. So you can't do it. And that's all you can do is you can't stop printing it because you made government too big. You got, like, if we look at the US, you got to pay the debt, and you got to pay the military, and you got wars going on, which are extremely expensive. And then you've got to pay Medicare and Social Security, and then you got to pay for all the employees, government employees that you keep hiring. You got the DOD. Well, how do you pay them? And all these economists and all these analysts who work for all these different, and then the Congress and the House and all those guys and all their staff, how do you pay for it? You print money, because we don't get enough taxes in, especially now as people are getting older. They're retiring or trying to retire. The money in the stock market's going to collapse, and that's really going to be a nightmare. Then people will all be broke, and CBDCs will not work. The control issue I showed you yesterday, I think I'll have to show you that. I don't recall there was about 30 minutes I kept going that it was a 47-minute video that said it was an hour and 30. So I lost 30 or 40 minutes, mostly on this. That's why I'm just doing this economic one. I will do my normal baseball and sports after. So this won't be too long. That's the plan. So that's Mark McGuire. Again, just really trying to show you BRICS and going Basel III and all the gold-backed currency and stuff that we all love so much. I mean, the U.S. is nobody wants the bonds, which is how we pay for everything. So if you want to go to the grocery store, you use your credit card, but you got to pay your credit card off. Well, if you can't pay your credit card off, you can't use your credit card. Well, if you need money to pay the bills of the government and to pay the debt and everything, they issue bonds, and people buy the bonds, and we get the money, and we'll owe it to you later, and we use that bond money to pay for goods and services, whatever the government buys. But the problem is the government can't get the money because nobody's buying. You got a $37 trillion debt, and there's all these conditions, and Trump is sitting there. Oh, you have to do that. We're not asking you, maybe, or we're not negotiating. We're telling you what to do, which nobody likes to be told, especially countries. So they all run to China, and China protects them. China destroys SWIFT. So China's basically getting out of the system and creating their own system. And it's fine, but it's there. All right, we talked a little about the digital CBDC, the digital yuan. We'll show 2 minutes of that.
10-year-olds use ChatGPT to organize their day. You can too. Here's how.
Let's be
Students, taxi control is being pushed back by the people, and now a wave of economic distrust is spreading fast. What was once pitched as the future of money is now triggering fear, confusion, and chaos. Why are Chinese citizens suddenly abandoning the digital yuan, even under government pressure? What unexpected resistance is rising in cities like Shenzhen, Chengdu, and Hangzhou? And how is this digital currency backlash shaking China's financial future? To understand why the digital yuan is unraveling so fast, we have to go back to how this all began and what Beijing hoped to achieve. The rise of the digital yuan. They called it the future of money. Back in 2020, China quietly launched pilot programs for its new central bank digital currency, the ECNY, or digital yuan. At first, it felt like just another tech experiment, a new app, a new payment method, another QR code in a country already dominated by mobile payments. But this wasn't just another payment method. By 2022, the digital yuan was rolling out fast, officially expanding across dozens of cities, including Beijing, Shanghai, and Shenzhen. Government workers were told they could receive part of their salaries in ECNY. Public sector students, same thing. Hospitals, train stations, town hall booths all began testing digital yuan infrastructure. The government framed it as a breakthrough. They promised a modernized financial system. They said it would reduce fraud, limit tax evasion, and help poor communities with financial inclusion. But behind the slick presentations and state media headlines was something else entirely. The ECNY wasn't just digital money, it was programmable money, designed to be traced, tracked, and even expired by the state. That means if the government wanted to, they could limit how long your money is valid, where you spend it, and even what you spend it on. Buy a train ticket? Fine. Try to buy cigarettes? Blocked. Donate to a protest group? Good luck. Transactions were no longer just private exchanges between buyer and seller. They became real-time data feeds to Beijing. The central bank could see every purchase, every moment, every transaction, instantly, and they weren't hiding it. In fact, officials bragged that ECNY would allow precise financial governance and social stability. At first, people went along with it, not because they loved the idea, but because they didn't have much of a choice. You see, the earliest adopters weren't tech-savvy volunteers. They were government workers, students on stipends, and employees at state-owned firms. In some provinces, even public school teachers were required to download the ECNY app or risk delayed wages. Banks started converting parts of users' accounts to digital yuan by default. Some citizens reported being forced to use the currency at public hospitals or train stations, even when other options were available. By 2023, the pressure was mounting. Posters appeared in subways. Join the future, use ECNY. Some cities even launched digital yuan lotteries, giving away free credits to incentivize use. But even with all the propaganda, subsidies, and government nudging, the mood was shifting. Throughout 2024, something subtle began happening. People stopped using it. Quietly, almost imperceptibly at first, merchants began turning off their QR code scanners. Customers started requesting Alipay again, WeChat Pay again. Even cash, the old money the CCP had worked so hard to phase out, began returning to circulation.
So you can see how well they want CBDCs in China. So everybody says, well, China's doing it. Yeah, but it ain't working there. And so is it going to work here? Is it going to work in Europe? Is it going to work in other countries? No. People want their freedom. What's the value of it? What's the value of the CBDC? Doesn't have one. How are they getting the value? Using the dollar? I mean, does this give you the value of the CBDCs? And if it isn't backed by gold, the CBDCs are worthless. As you can see, Say's law, there is no demand for this China CBDC. Nobody wants it. Therefore, it's worthless. Therefore, it's zero. And notice what they did. The people, the public sector people, the teachers, the people working for the government had to take it. But the regular private guys working at Apple or at Nike or Microsoft, they didn't want it. They wanted to go back to the dollar, or I guess those were credit cards they were talking about. So this is the problem as far as trying to push something nobody wants, like electric vehicles. I don't know what Trump and Musk are fighting about, like a bunch of children, but Musk is like, well, I'm going to take my ball and go home. Trump's going to export. I mean, who knows? It's all bullshit. So anyway, that's the problem with CBDCs. Now let's go to, there was one on Egon yesterday. Let's watch Egon.
As parents, we always want to protect our kids, but have you thought about what happens
if demand increases? There'll be pressure on these paper short goals to deliver, and they can't deliver. And this is when gold will go up by as I said, over time by multiples. So as you said, the time to get your gold is now, because it's still very inexpensive compared to what it will be in the next few years. So there's the short squeeze of gold shorts combined with the massive demand of physical. That bodes very ill for the people who are now short gold, and for the bullion banks and for the central banks. And this is why, and which means there's going to be massive upward pressure on the gold price. And you've got to...
Egon von Greyerz, founder and managing partner of Von.
Okay, so again, it becomes back to economics. Everything comes back to Austrian economics, supply and demand. Is there demand for gold? Yes, that's why the gold price is going up. It really is. Inflation really raising the gold price? According to Alligator McLeod, he thinks that it is. He thinks, well, it's not gold going up, it's the dollar going down. That's horseshit. The people getting out of the dollar have to buy gold. The demand for gold is what pushes the price up, as if the demand for a Mantle card or the demand for a Rolex or the demand for the Canadian Club 12-year. If people want it, the price will go up. So why is Egon saying, look, the price is going to go really high. Like right now it's low, you should get into it, and then it's going to really go. And that's what he's saying is basically, it's basically going to go up quite a bit. I feel at least, 10 grand's now, but I think eventually it's 50 grand, and then it just goes where the dollar craps out, and then it's whatever gold's worth. Then things will be priced in gold, like back in the Roman times. Everything was priced in gold and silver. You didn't have fiat currency until you took the gold and silver out of the coins. It worked fine for 500 years. That is the problem, but it's whatever the demand is. If there's no demand for a product, if there's no demand for this, because people are tired of being bullied, and China's getting out of it, and Japan's getting out of it, and Europe's getting out of it, then it doesn't have a value. It's as simple as that. People can, how's the reserve currency? What does that mean? If you still print $150 trillion, and now the petrodollars are coming home and the FX dollars are coming home, so you don't need the dollar to buy Saudi Arabia oil, and you don't need the dollar to make FX transactions between China and India, and China and Brazil, and China and Iraq, and Russia and Iran, Russia and India. You don't need the dollar to buy it, where that's what you needed before. So you needed the dollar to buy, maybe euros or Swiss francs. Now you don't. You just, maybe the euro you still do, but most of what China and Russia and BRICS are doing is not using the dollar. Well, that's a lot of dollars that are printed are coming home. So now you've got all these printed dollars. Nobody wants them. Japan's dumping, China's dumping. Nobody wants it. And they all go to the lifeboat of gold. So I was talking to my neighbor again yesterday. And, so you still think gold's going to go up? And I says, well, the real idea is that the dollar is not going to be around. It's not going to have value. And so you're getting, really what you're doing is you're getting out a dollar. You're getting out of the US dollar. You're getting out of your rupees. He's Indian. You're getting out of Swiss franc, whatever it is you're in, you got to get out of it because they're all going broke. The euro, you got to get out of it. And the only lifeboat is gold and silver. So you're really not even buying it because it's going to go up. It's not an investment. It's the money. You're using that to go to the grocery store and to go out to eat and go shopping and pay your bills. You're still using dollars to do it, but they don't have a value. So you need gold to do it, and gold will not lose it. The difference is 100,000 in dollars goes to zero. 100,000 in gold goes to 200,000 or 10,000 or 100,000 or a million, whatever, 500,000. So 100,000 goes to zero. 100,000 gold goes to a million. That's what I was trying to say. And that's really the difference. So why are you buying gold is because you're getting out of the dollar, which Alligator kind of has right, but he's kind of weird. I mean, he says, well, they're not buying gold, they're selling dollars. Well, they are buying gold with the dollar. I don't say I'm selling dollars. I'm saying I'm buying gold and I'm doing Rumpelstiltskin. I'm getting out of dollars to buy the gold. That's what they're doing. That's what these people are doing. So keep that in mind. So let's watch a little bit more of Alligator.
AG
I think
continues
we've
to warn
watched
that
this,
the gold
but it's a
market has
review.
long been manipulated through paper derivatives by what he refers to as a cartel of entities, including the LBMA, bullion banks, and central banks. According to him, this system of price suppression only works as long as investors avoid demanding physical delivery. Once that dynamic shifts and physical demand outpaces supply, gold prices could rise not gradually, but by multiples. In a recent tweet,
And that's where we're at. COMEX has worked for 50 years, but now the physical demand's taken over, and that's what's crushing COMEX because they can't play the game if people want the physical. Because they can only play the game. It's like musical chairs, but if everybody takes their chair, there's no musical chairs. There's no chairs left to play. That's what's happening. So people taking the gold and silver, and there's nothing left. They can't play the game anymore. And that's why it'll go up in multiples, because now the quicker people realize the Titanic is sinking, and after they get over, well, how can it sink? It's unsinkable. And then they realize, well, we're 90% in the water. I think it is sinking. So once you realize that, you then you run to the lifeboat. And that's what's going to really push the prices up, is when people realize their dollars are worthless. And they'll realize it when they go to the grocery store and everything goes from $2 to $20. Dark chocolate went from $2.20, and now it's $4.79. And buy two for $8. They can't sell it at $4.79. I think it's a little bit steep price, but that's how they need to make money, is to charge that much, or we're not going to have dark chocolate. And I think a lot of it is the cocoa price went up for some reason. So they're manipulating that, but that's what they need to sell it at. But you're over market, and that's my whole point about over market. All of a sudden, you want to sell the dark chocolate that you've been selling for $2 for $4.79. Nobody's buying it, and then you see it on sale, 2 for $8. Well, I can get 2 for $5 at Walmart. Why would I pay 2 for $8 at Meijer's? So I'll buy another brand at Walmart, save $3 for 2 bars. I'm going to do it. And I get my avocados there anyway. So it's like, okay, get some avocados, get the dark chocolate. So I kind of kill 2 birds with 1 stone when I go there. It's funny. Alyssa said, do you plan? And do you plan everything? And I said, you have to plan everything. So like now I'm planning my classes, and then I'm planning, having lunch, and then I plan on going to the pool, and then I plan on, okay, at the pool, it's close to the Walmart, so I'll go to the pool, then I'll go to Walmart, and I think I need gas for my trip on Friday. So yeah, it's like, okay, well, wait, when you go to Walmart's, when you go to the pool. So I always go to the pool to go to Chinese because it's halfway there, and I go to the pool when I go to get barbecue. So I always plan that in. It's included in that. Okay, I'll do it after I swim because I'm going to swim anyway. So instead of going there, coming back, and then going to the pool and coming back, I kill two birds with one stone. How do you not think like that? So that's the difference. Anyway, so that's what we're trying to do. So there's a little bit more, Egon, I want to show you.
Greer
This
highlighted
just came
that
out
gold
yesterday.
has reached more than 75 all-time highs in 2025 and continues to
Paper
outperform
highs.
equities over the long term. This is not the top of a bubble. It is the early stage of a larger monetary shift. The data backs this up. Gold prices edged slightly higher in early U.S. trading Monday, while silver saw modest losses. Gold had touched a 5-week low overnight, but this dip is widely seen as temporary in the face of mounting macroeconomic shifts. The US dollar has dropped more than 10% in the first half of 2025, marking its worst H1 performance since 1973.
If you can't read small print anymore because of vision problems, try this simple ice hack with water before
half of 2025, marking its worst H1 performance since 1973. Uncertainty around President Donald Trump's economic policies and a general reassessment of U.S. dollar exposure have fueled the sell-off. Von Greyerz explains that as fiat currencies continue to erode in value, gold denominated in those currencies will naturally rise. Combined with growing central bank and institutional demand, the setup is becoming ideal for a significant move higher. He believes a short squeeze in the gold market is not only likely but imminent, driven by a surge in physical demand that the current system may not be able to absorb. Bloomberg reports support this thesis, noting that institutional demand for physical gold has reached multi-year highs. Major buyers are treating price corrections not as signs of weakness, but as strategic opportunities to increase their positions. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
We know that in Europe and in the US, the futures markets and the banks, the banks have even bigger futures contracts outstanding. It's at least 100 to 1 leverage, physical against paper gold. And as more and more people ask for delivery, and as central banks are continuing now to buy physical, there will be massive shortages. And we talked about it for a long time. They've been very skillful, the cartel, the LBMA, the bullion banks, and the central banks, in holding the gold price down with the help of these derivatives. But as the world asks for delivery, the gold is not going to be there, and that's when we will see gold going up by multiple. That's going to come. This is not from a gold bug who's optimistic on gold for the sake of it. This is someone who's very pessimistic on the world and the world economy and the amount of money that will be created and printed, which means the debasement of the currencies, which means measured in currencies, that gold will go up because the currency is going down. And on top of that, as you just showed, there will be the increased demand from all corners of the world, central banks, from institutions, etc. Remember that the average investment in gold today is only 0.5% of world financial assets. That will increase, but there's not more gold around, and especially if demand increases, there'll be pressure on these paper short golds to deliver, and they can't deliver, and this is when gold will go up by as I said, over time, by multiples. So
So again, it's supply and demand. It's back to Austrian economics. Demand goes up because the dollar's worthless. So you printed too many dollars, which makes the demand go down and makes the value go down. You can't have currency's got to be limited. You can't blow it out and then wonder why there's no value in it, which then forces you into the lifeboat, and you look around and you only have one option, gold and silver, which forces you into that, which then forces demand for gold and silver to go up, but the supply is not there. There's not a big supply in gold and silver. So therefore, you raise prices. If everybody wants, if they made 100 bottles of this and all of a sudden 1,000 people want it, well, the price is going to go up because they can. You go, oh shit, everybody wants it. Well, it's not going to be 100, it's going to be $500, and people will pay because they demand for it. So the demand for gold, but gold works differently. It's money. And as the dollar goes out and people start realizing they need money to live on, to eat, to pay your rent, pay your utilities, as they realize this, they realize they have to buy gold and silver at whatever price. So as much as they can buy, and that's why silver will go up, because most average people can't afford $10,000 gold, or if they can, it's 1 or 2 ounces, not 20 or 30. And it's taken me years to get up to where I'm at, and it's basically you buy 3 or 4 ounces. 3 ounces is now $10,000. So you buy what you can, and you keep. If they buy a 1/4 ounce, I'll buy 1/2 ounce. 1/10 of an ounces. It doesn't matter. You're adding to your inventory, and as the value goes up, all your inventory goes up, and your silver, and that's your only option. There's no other option there, right? You're buying the gold and the silver because that's the only real money that won't go bust. And they never get it right. The reason it doesn't go bust is they can't print it. They can't inflate it, right? If you can't inflate the gold, of course it's going to stay around. Now the question is there always demand for gold? Well, since the Romans, there was demand for gold. They used gold and silver. And really since then, different countries had it, Spain and Amsterdam and France and then England and now us, or the US. So you have it, but there's always been demand for gold, and it's always been limited, so you can't print it. Why get off of it? Because for these wars and government spending and all this crap, I don't know where that came from. You get some idiots in charge who don't understand economics, and they'll go, oh, well, we'll just print more. We'll get off gold and print more money. And that's a big problem. All right. So again, high demand, low supply, high price.
You said, the time to get your gold is now, because it's still very inexpensive compared to what it will be in the next few years. And so there's a short squeeze of gold shorts combined with a massive demand of physical. That bodes very ill for the people who are now short gold and for the bullion banks and for the central banks. And this is why, and which means there's going to be massive upward pressure on the gold price, and you've got to own your gold now, and you have to own your silver now, which because the silver market is even smaller and will go up a lot faster than gold. So, but it has to be physical, and of course, it has to be stored outside the banking system. You're protecting against a fragile or bankrupt banking system, and you must obviously not hold it in any paper form or within the banking system that you're trying to protect against. That's so obvious. So please protect yourselves as much as you can, because that's one way to at least survive the financial crisis that we will have in coming years. We can't do anything about the political crisis. It's hard to protect yourself against that, but at least financially you can, and please do. But you could hold some, even if they hold gold, have some silver if you can afford it. Of course. At this point, per ounce, an ounce of silver costs almost 1/100th of an ounce of gold. So of course it's a very inexpensive metal, and it's a metal that is produced in relatively low quantities, and it's a metal that is also very much industrial, and therefore there are no surplus stocks of silver, and this is why an increase in demand will lead to a real price squeeze, and silver will go up 2-3 times as fast as gold, at least in the next move.
Egon von Greyert suggests that a recent note from Citibank reveals more than it openly admits. He believes that what the bank is signaling is that it holds significant short positions in gold.
Here's a quick way to shrink mouth wrinkles and make them vanish for good. Women are always asking
Is that it holds significant short positions in gold and needs the price to fall, ideally by as much as $1,000, to close those positions profitably. According to von Greyerz, this is why Citibank is taking a bearish stance, attempting to influence market sentiment and drive gold prices lower. In its latest forecast, Citibank lowered both its short-term and long-term gold price targets, projecting that gold could drop below $3,000 per ounce by late 2025 or early 2026. The bank attributes this outlook to expectations of declining investment demand and a more optimistic global growth trajectory. However, this view appears at odds with the current market dynamics, where persistent geopolitical risks, ongoing U.S. budget concerns, and potential tariff policy changes continue to support gold prices in the $3,100 to $3,500 range. Citibank acknowledges that, in its base case, gold is likely to consolidate within this range during the third quarter of 2025. It also notes that, in a more bullish scenario, prices could exceed $3,500 per ounce due to heightened investment interest and economic uncertainty in the United States. Despite this, the bank's broader forecast anticipates a retreat to around $2,500 to $2,700 per ounce by the second half of 2026. Let's get back to the interview.
That guy from Citibank, all he's telling us is that Citibank is massively short gold and they need to cover that $1,000 lower, and they're going to try to do whatever they need to do to get the gold price down to be able to buy back their shorts at a lower price. They will fail, in my view, because gold is not going to be kind to them. Gold is in a very strong uptrend. It's more likely to accelerate here to much higher levels. I've stopped giving predictions some time ago because I think it's ludicrous to give a prediction in paper money, and because you don't know what the value of the paper money will be at the time. So that's why all I'm saying is, because of the fundamental and technical situation that we see for gold, and the geopolitical situation, and the continued massive increase of debt, and therefore debasing of currencies, and the central banks move of their reserves out of US dollars into gold also. Because of these factors, gold is going to go up by multiples in coming years. And I feel quite strongly about that. And in any case, it's not the increase that you should think about. You should think about instead protecting your assets. Gold is one of the best ways, probably the best, to protect your assets or insure against the risk that we see coming now. And you know for certain that you are going to maintain your purchasing power and maybe even enhance it, because gold will probably go up by more than inflation with this scenario and all these factors in its favor. So we are going to see a permanent re-rating of gold. As we have said before, Jan, gold is nature's money, only the money that has survived, and therefore it's not a question of a commodity going up too fast and too much. It's a question of a total revaluation back to where it used to be, that is gold being the only real money, and that there is, and therefore gold's value will now change dramatically and permanently for many years to come. One day China will annex Taiwan, there's no question about it, but they're not in a rush. Their ultimate goal is very clear. They will take Taiwan, and I believe that's what they've said. But they don't care if it's 10 years from now, or it doesn't have to be tomorrow or in a couple of years. It could be later, and they probably would do it at the point when America is weak, not when America is in a war mood like they are now. Maybe when America is occupied elsewhere, or financially weak, or politically weak, that's when they will do it. This is the thing about China. We've got to realize that they don't plan for the next year or for the next 4 years like Trump, and trying to take thousands of executive orders or issue executive orders to make a lot of short-term decisions that will be reversed by the next president. Only short-term thinking, short-term gratification with no long-term goals, as opposed to China that plans for 100 years or so. Yes, Taiwan will fall one day, but no hurry. They have more imminent problems, and of course, if the world will suffer, and if these tariffs continue, China will suffer like everybody else. The big advantage they have is that they control their financial system quite well, so they are not dependent on world markets and borrowing on world markets. So although they will suffer there, they can sort it out internally, and everybody has to tighten their belt, but they're certainly not dependent.
Well, I disagree with that. They still are dependent. You got to have sellers. And if I'm going to sell Canadian Club, there's got to be a buyer out there. So I can't sell it to myself. I have to sell it, and there has to be a buyer. So they are dependent. That's what free trade is. Free trade is you trade with other countries, and you have to have people. You have to have a market where people want what you're selling. Anyway, so that's what I wanted to show you with Egon. So what's he saying about Citibank that maybe got you a little uncomfortable? Their target's 2,500 gold, and he killed that. And he said that's never going to happen because there's too much demand. Citibank's trying to get out of their underwater derivatives. This is the problem playing options and derivatives. So they want to sell it for. They want to get back down to 2,500 to make money on their derivatives. The hell are you shorting gold for when it's the biggest demand there is? This sounds like the same idiots with the housing market at the Die Hard 3 guy in that short the margin call movie when nobody saw the housing market crashing. I mean, where were they in that to see? The difference between me and a lot of these idiots are I look ahead. I see what's going on. I see the water rushing into the boat. I see we hit the iceberg. I see what's going on. I see you're printing the dollars. That's gonna end bad. So when Biden started printing these $5 trillion budgets and budget deficits and we got to help people. Here's $5 trillion. Well, that's going to kill the dollar, which is what it did. So I could see from that event happening what was going to happen. So I can look down the road. That's my specialty. And what we're not seeing in the margin call movie is they didn't see that with the housing market. Well, if you would have understood that the banks are giving loans to people that have no credit, of course they're going to end badly. So that's the first thing is why the banks don't see it. And the second thing is with all this, with what Biden did, knowing that's going to kill the dollar, is all this spending. And then it became, where should I put it? And the only place was gold. So 5 years, when Biden's still in there, his first or second year, I'm already buying gold. I'm not waiting to the end. So why in God's name would you short gold? Why would you do a short option? And then you're not smart enough to realize it's bad. Oh no, we'll wait till gold's up to 3,500 and then we'll try to get it down to 2,500. Yeah, that'll work. Whoever's running that bank are a bunch of idiots, and I don't know if they'll even be there because once they lose on all these, and I don't know how long these are good for. It's been a couple of years when gold was 2,500. So how long are these options good for? I don't know, but it's going to bankrupt the Citibank. If you have stock in Citibank, I'd get the hell out of it because it's clearly fucked. They clearly can't cover, and they're going to have a lot of losses. They'll never get gold down to 25 to sell it. I mean, who's the idiot in charge of that? Well, you just shake your head how stupid these people are. So you got to see what's coming. So there's always a cause and effect, which is what I teach. You print a lot of money, makes the money worthless. Where's the lifeboat? No, the euro, no, Swiss franc, no, British pound, no, gold and silver. So as there's an effect, there's a cause, there's an effect. I can't remember the terms. It's like an effect and a cause and an effect. So the cause now is BRICS buying gold. That's going to make the price of gold go up because there's demand. That's the cause is BRICS getting out of the dollar because Russia can't play and China's problems and everybody basically going bankrupt in the dollar. So it's BRICS coming into play. I go buy gold because they're buying gold. the demand for gold is going up. So I'm going to get on that elevator and take a ride with them. Cause and effect. The dollar, nobody wants. The fact, it's going to be worthless. We know that's what's going to happen. There is no time limit. It's not a football game. I can't tell you. I'll tell you it's on at Sunday at 1 and it'll end at 4. And I'll tell you, then we'll know who won or lost. And it's the same thing. You can't do that with the dollar. So you're looking at that. I said China crushed the US dollar. Well, let's take a quick look at that one.
This hits your wallet. A weaker dollar spikes import prices from oil to... President Trump just lit a fuse under the global financial system. His plan to replace Fed Chair Jerome Powell early, months before Powell's term ends in May 2026, has unleashed chaos. The US dollar just tanked, suffering its worst quarter in over a decade, down 10.3% year to date. Wall Street's shrugging it off, but Beijing's throwing a party. China's ditching U.S. treasuries, rolling out gold-backed contracts, and rewriting the rules of global finance in real time. The Shanghai Gold Exchange just opened a massive vault in Hong Kong. Foreign investors are flooding in, and every dollar they sidestep shifts power from Washington to Beijing. China's making a play that could end the dollar's reign as the world's reserve currency for good. And their next move? It's the one nobody's ready for. Here's what's happening. Trump's signal to replace Powell, reported by the Wall Street Journal, sent markets into a frenzy. Traders are betting on a rate cut by Q4, even with inflation running hot at 3.6% to 6% annualized and no Fed agreement on easing. Rodrigo Catril from NAB says markets are acting like Powell's successor is already calling the shots, fueling a sell-off in Treasury futures. Bloomberg data shows the dollar index plummeted 1.8% in just 2 days after Trump's comments at the NATO summit. This isn't just policy chatter, it's markets jumping the gun. If trust in the Fed's independence crumbles before Powell's out, what happens when the new chair takes over? Foreign investors are already bailing on U.S. treasuries, dumping $194 billion since January, per Reuters, the biggest drop since 2015. With the 10-year Treasury yield stuck at 3.97% and inflation outpacing returns, bonds are losing money in real terms. Meanwhile, China's slashed its U.S. debt holdings to $775 billion, the lowest in 14 years, citing America's unpredictable policies, according to Nikkei Asia. Wall Street's sounding alarms. Morgan Stanley warns the dollar could slide another 5 to 7% if Powell's sidelined early. And it's not just numbers. This hits your wallet. A weaker dollar spikes import prices from oil to tech. The U.S. trade-weighted oil import index surged 12.6% this quarter. If this is the controlled decline, how bad does it get when things spiral? China's not waiting around. The offshore yuan's up 2.4% against the dollar since April. Beijing's launched 16 new futures contracts for foreign investors. Think rare earth metals and more, via the Zhengzhou and Dalian exchanges. This isn't random. It's a master plan. People's Bank of China. Governor Pan Gongsheng told the Lujiazui Forum that China's building tools to bypass Western financial systems. The Shanghai Gold Exchange's new Hong Kong vault? It's already pulled in $10.5 billion in its first month, per South China Morning Post. That gold isn't just shiny. It's a trust anchor free from the Fed's grip. When a reserve currency wobbles, rivals pounce. China's gold-backed yuan trading is a direct challenge to the dollar's dominance. If this chain reaction keeps rolling, the dollar's fall could reshape the global economy and America's place in it. The U.S. is losing ground, not to gold, but to liquidity, and China's just warming up. Let's break it down. In May 2025, U.S. goods exports tanked by 5.2%, driven by sharp drops in industrial supplies and capital goods, according to the Bureau of Economic Analysis. Even crude oil exports, once a cornerstone of U.S. trade power, fell 7.1% month over month. That's a blow to the White House's energy dominance narrative. Meanwhile, China's playing it cool. No new tariffs, just quietly slashing orders for U.S. semiconductors and aerospace parts. This subtle move puts real pressure on American manufacturing jobs. BCA research says this non-tariff strategy is smarter than sanctions because it signals a long-term economic decoupling. The result? The U.S. merchandise trade deficit ballooned to $11.6 billion.
All right. There's no such thing as a trade deficit. All right. First of all, inflation, they don't know what they're talking about. It's not 3%. It's not year over year. You got to go back to 71. And inflation is probably 30,000%. I mean, if we look at gold at $35, every $35 is 100% inflation because it takes more dollars to buy the ounce if we don't include the demand for gold. So, call it 20,000% if you really care, but that's not how you measure inflation. You really don't measure it. It's not really to be measured in percentage and you play score. Oh, it's up 3% year over year. That just makes it look better. Oh, we're not inflating our money, which most people don't even understand what inflation is. It's printing the money, which makes it worthless. It's the dollar that is inflated. You're inflating the money supply, which makes it worth less because you have too much dollars printed. Costs go up or down are independent. It's not all costs go up. Some can't. If there's competition, you can't raise prices. So this is the whole key to it. So when they talk about, once they start talking about trade imbalance, there's no such thing. Again, if I trade you a Canadian club and you give me $100, there's no trade imbalance. I traded you whiskey and you gave me money. Money's it's just as good. That's the trade. I don't get where they come, and then everybody buys this trade imbalance as if it's gospel, just like everybody buys inflation. Oh, it's 2%, 3%. It's all bullshit. It's all lies. I mean, there's no such thing as a trade imbalance because we've been giving China money. They've been giving us goods and we pay for the goods with money. There's no trade imbalance. And then they buy our bonds with it because they can't use dollars in China. They have to use the yuan. So they take the dollars and buy treasuries with it, but they're still using Chinese dollars. So if they make Apple iPhones and we buy them, there's no trade imbalance, and we're not there to trade them back Apple iPhones. So this whole trade imbalance is ridiculous. Anyway, that's about all I wanted to say, is to show this, to explain. We explained Basel III, why we're so excited. It then creates gold and silver out of COMEX paper into physical. Mark McGuire said, even if they don't want to do it, they have to do it. There's no avoidance now. Everybody wants physical. And then Egon said, hey, Citi's trying to short because they have a bunch of derivatives that they need to buy at 2,500, which is not going to happen. Too much demand for gold and silver. The price will never slip to 2,500. Everybody buys it. It went down to 32.80 and everybody bought it back, and it's back to 33.40. Let's take our last look at that. And then here you can see that the dollar's gone. Anyway, so see, I like the comment. What is Basel III? What it means for investors? We are not investors. We are not really investing. We kind of are, but we're not. We're getting out $1 to save our ass from that. All right, it's 12 o'clock. There's gold sitting right at 33.40. See, it does this little dip down to 33.35 and it gets bought back to 33.40. There it took a little dive, 33.30, and it went right back up. So again, we're caught probably till Friday. We'll see, because it's July 4th. They won't have it. silver's doing well, 36.46. Again, it doesn't move as high, but it will once the dollar goes out and people realize they need real money, and they need limited. The only choice is limited money, gold and silver. And then that's when the floodgates will open, and that's what we're waiting for. So the biggest problem we have is if you need money, you don't really want to sell your gold and silver. You certainly don't want to sell your silver at 36.45. That's ridiculous. It'll be 1,000 an ounce, if not more. It'll take a little bit of time. It's not going to be tomorrow, but it's going to go to 100 and then 500 and then 1,000. Makes you, how do I sell it? I don't want to sell it at 36 when it's going to be, let's say, 500 or even 100. Why would I sell it at 36? And the same thing with gold. Why do I want to sell my gold at 33.40 when I know it's going to be a $20,000 an ounce piece when it explodes? And that's really kind of what you're trying to explain to your loved ones, your family and friends who need money, and go, I don't have it. I'm not going to sell my gold, but don't worry, we have gold, but I'm not selling it now. I'm holding it till the price, because I know the price is going to go up. So why sell it at 33.40? Again, you only sell one if you really need it. You sell 1 ounce and then you pay bills or whatever you need it for, go on a vacation. But you want to keep, let's say you have 100 ounces of gold. All right. So now you're worth $330,000, but it's going to $1 million, right? It's going to go to 10,000 an ounce easy. So what I would do is I would take 75 ounces and I'm not touching this. And then I can maybe play with 25 ounces, but even then I probably don't want to play with more than 4 or 5 ounces where I sell them to do it. That's just what you want to do. So if it's a desperate need, you need money, you just sell an ounce of gold, and it's 33.40 now. It's going to go up to 4,500 in the near future, probably by the end of the year. And so why sell it for 33 when you can get 45 for it? And I would buy anything. I would buy Maple Leaf, Cougaran, Eagles, Buffaloes, Philharmonics. They give you a discount for some strange reason, but if you notice, the price of gold is 33.40 is the price of gold in the world, not the U.S. price of gold for a U.S. Eagle or Buffalo. It's gold is 33.40. So if these guys want to sell it cheaper because people don't want to buy it in the U.S., they're more apt to buy the Eagle. I don't know if they think it's a tax purpose or just what. I'm more than happy to buy a Cougaran and save $60. Thank you. Because I'm buying an ounce of gold, which is 33.40. So it's still 33.40, the ounce I bought. Now in the US, people don't know, but as the shit hits the fan, and it's just like the Titanic. The first people that realized that got into the boat. They got into the lifeboat, was fine. But as the ship was sinking further and further in, more demand for the lifeboat. The lifeboat, there was not a lot of supply, and at the end, the idiot Rose's fiance then started. Here's $1,000 to get on a lifeboat. And the guy just looks at him. Monies can't help you. There's no more lifeboats. So that's what's going to happen. Is they'll just take any gold. The synopsis is they'll take whatever. Oh, it's an ounce of gold. And they're going to give you an ounce of gold for it because it won't matter at that time, because they'll be looking for gold, and it won't matter if it's a Philharmonic or that. Maybe you sell your American gold first if we're in America. Maybe you get a better price, but we're going to get a better price on the Cougaran and the Maple Leaf and the Philharmonic down the road because it's an ounce of gold, and there's not going to be a lot. And if you have to go to Switzerland to sell it or somewhere in Europe to sell it, then go sell it there. If you're in Europe, go sell it there. I bet it's not the same premium for the Eagle. Anyway, that's today's class. I did want to talk Basel. Again, I tried to do this yesterday, and I kept getting the internet disconnection, so I didn't want to try to do another one. This is strictly on what is Basel 3, and a little bit more economics. And now I'm going to do a class on baseball and sports, and it's Bobby Bo Day yesterday. He should fire his agent. He cost him millions of dollars, the agent, and we'll explain Bobby Bo Day. Bobby Bo, happy day. I'm glad you got $1.2 million, which is actually worth about 120,000. But you know, what can I say? Go buy gold with it as soon as you can. All right. Have a good day. www.teaserking.com, and I will be right back and do baseball. All right. Take care, everybody. Thank you very much.